Shivani mentioned the most important section, taxation, while planning your retirement. So, today what I speak is importance of tax planning while you are doing your retirement planning. So, in this I try to cover the tax implication of different investment products and investment avenues. Why this is an important topic? Because most of the times what happens is we compare different financial products without considering their tax implications. Like I compare one investment product or with one investment instrument with another without considering the tax implication. So say for example, the first investment instrument has no tax implication, it is a tax free, and another has a 25%, 30% tax implication on money earned. The post-tax return in option 2 will reduce. So it is very important to understand the tax implication of different investment products and integrate it with your tax planning. Whether you are falling in 10% tax bracket or 20% tax bracket or 30% tax bracket. So, which are the different investment options if you are planning your retirement or if you are already retired? So, first, very important investment avenue which is very famous today and getting more and more famous is mutual funds. Second, bank fixed deposits. Indians are investing majority of their money where? In bank fixed deposits. Then senior citizen saving schemes and different post office schemes. Senior citizen saving schemes which was being launched somewhere in 2004, which has a maximum investment that you can do, one person can do is 15 lakhs, husband and wife can invest 30 lakhs, which gives you guaranteed return of 8.30%. And it is available in post office as well as all the nationalized banks. It gives you quarterly return and for 5 years. Pension schemes. So what are the tax implications? Now let us look at one by one. What are the tax implications of all these financial products? Mutual funds. Mutual funds can primarily be divided into two categories: equity funds and debt funds. Which are equity funds? See, what we understand is equity fund is a fund which is investing into stocks. So, one point that I need to clarify here is that if a fund, suppose a mutual fund is investing into a fund of fund which is investing into US stocks, is it an equity fund or it's a debt fund?
Equity fund.
Okay, from investment point of view it's an equity fund, but from the taxation point of view it's a debt fund, sir. Tax implication will be of the debt fund. If any fund which is investing less than 65% money in Indian equity is a debt fund. Okay. So, what is the tax implication now? So, equity fund, long-term capital gain is divided into two parts as far as equity mutual funds are concerned: long-term capital gain and short-term capital gain. Long-term, when you have invested money for more than 12 months, it's a long-term capital gain. You invest money today and you withdraw after 12 months, it becomes long-term capital gain for equity mutual funds. So, what is the tax implication? 10%. Earlier it was tax-free. From last year's budget, 31st January 2018, it has been made taxable at 10%. But one very important point which we should consider is 1 lakh rupee capital gain in a financial year is exempted from equity. So if you have a capital gain, if you bought something at 1 lakh rupees, and if you sold it at 2 lakh rupees, you have a capital gain of, long-term capital gain of 1 lakh rupees. So it will be exempted in one financial year. So another point which is important is there is a grandfathering clause. What is this clause? So if you bought some equity mutual fund or equity shares before 31st January 2018 and if you sell it today, what will be the purchase cost of acquisition for calculation of capital gain. Cost of acquisition will be the price or NAV of 31st January 2018. Suppose you bought some equity share or equity mutual fund at a price of 10 rupees in say 2014, and if you sell it today at say 30 rupees, what will be the capital gain? For that you have to refer to the NAV of the 31st January 2018. Suppose the NAV of 31st January 2018 was 35 rupees, and today the price NAV is 30 rupees. Your capital gain is 0. But it will not allow you to book a capital loss. You will not be allowed to book a capital loss. Capital loss can only be booked if you bought something after 31st January 2018 and today it is negative from that price. Okay? So this is grandfathering clause. What happens if you have a short-term capital gain in equity less than 12 months? Your holding period is less than 12 months. Capital gain tax is 15% of the gain. Whatever gain you arrive at, 15% is the tax that you have to pay. Then other category of mutual funds, debt funds, which is more complicated as far as taxation is concerned. Long term, वहाँ पे 12 months में हो रहा था, यहाँ पे 36 months में. Your holding period should be more than 36 months. Then only your investment in debt funds become a long-term capital gain. Then what is the tax applied? It is 20%. Whether you are falling in 10% tax bracket or 30% tax bracket or 20% tax bracket, it will be 20%, but only after giving the effect of indexation. What is indexation? Suppose you invested 100 rupees and you hold it for 4 years and it became suppose 140 rupees. So there is an inflation index which is declared by the income tax department every year, which is linked with the inflation figures declared by the government of India. So that increases your cost of acquisition. You bought it at 100 rupees and there is a indexation which you have to put for that year in a year of buying, and today's this year's indexation. Suppose there is 100 rupees becomes 125. So only 15 rupees is your capital gain on which you are supposed to pay 20% tax. So you get the benefit of indexation. The same benefit you also get in property if you hold it for more than 2 years. Short-term capital gain, less than 36 months. If you have a debt fund investment and you hold it for less than 36 months, it is a short-term capital gain. And on that short-term capital gain, it is added to your income directly. So you have to pay the tax as per your tax bracket. If you are falling in 30% tax bracket, you will end up paying 30% tax. So whenever you are planning your debt investments, try to hold it for 3 years. One more important point is, suppose you invested something in debt fund 3 years before. Today you want to withdraw the money. This is month of March. What if you withdraw it in the month of March? And what if you hold it for 1 more month and if you withdraw it in the month of April? If you withdraw it in the month of April, you will get 1 more indexation. Because indexation happens every 31st March. So effectively your tax rate will reduce. I will show you with one of the examples also. Tax implication from bank fixed deposits, senior citizen savings schemes and postal schemes. All those schemes, their income that you receive arise in the form of interest. What happens in mutual fund? It was arising in the form of capital gain. So here the income arises in the form of interest. So interest, whatever you receive is taxable under the head income from other sources. In your income tax return, you have 5 heads of income: salary, income from other sources, house property, profits and gains, and capital gain. Okay, so this is taxable under the head income from other sources, and it is taxable on the accrual basis. Suppose you made a FD of 1 lakh rupees for 5 years. It is a cumulative FD. You will receive the final amount at the end of 5 years. What happens at the end of 1 year? They deduct TDS from your interest and you have to pay the further as per your further tax as per your tax bracket. Suppose you are falling in 30% tax bracket, so they have deducted already 10%. Suppose the interest rate was 10%, they have deducted 1000 rupees on that, and you have to pay further 2000 rupees because you are falling in your tax bracket. Why? You have not received any income from them, but it is accrued in your name. So taxation happens on the accrual basis, whereas in mutual fund it is capital gain, so it happens on the receipt basis. This is the difference. Okay. So interest is taxable on an accrual basis. Let me give you one comparison. This is a very important topic because people compare the returns of debt funds with the fixed deposit without considering the tax implication of both. So what happens actually? Say this is I have taken an example of 7% fixed deposit and 7% debt fund. What happens in fixed deposit? You invest 1 lakh rupees, and first year suppose 7000 interest होता है. 7000 के इंटरेस्ट पे आप 30% में बॉल कर रहे हो, 2100 रुपीज टैक्स निकल जाता है, आपके हाथ में कुछ भी नहीं आया है. You have not received a single paisa, but you are paying tax on that. Second year, the interest would be 7490, you will end up paying 2247. Third year, interest would be 8000, compounding as the interest बढ़ रहा है, you end up paying 2404. Fourth year, 2575. Third year, you pay the interest and you pay the tax on interest and you pay the final maturity of 1,37,502. Now, when I take out the net of tax return, post tax return, what is that? 4.90%. Because you pay the tax. In case of debt funds, 7% return आया, you invested 1 lakh rupees, nothing, no tax to be paid in between. In the year of withdrawal, 50 year, 138,968 आपका withdrawal आया, उस पे आपको जो capital gain हुआ, indexation के बाद आप tax pay करोगे, it is somewhere close to 6.80%. So effectively, the rate of return here is 4.90, the rate of return here is 6.80 post tax. This is where we miss the bus. People compare 7% versus 7%. So, while investing in debt funds, if you are planning for your retirement, if you invest all your money, you have to consider your tax bracket. If you have an income less than 10 lakhs rupees, your taxation will be accordingly, your decisions will change. If you are above 10 lakhs, your decisions will change. Few other important points which one should keep in mind: pension, any kind of pension. Whether there are two ways you can receive pension. One is from employer. Another pension that we receive is from LIC policies or any life insurance pension plans. Both the pensions are taxable. Your life insurance pension will be taxable, annuity will be taxable under the head income from other sources, and pension from the employer will be taxable from under the head salary. Money invested in the spouse's name. Lot of people think after retirement that I split the money, whatever I have received as a retirement, and invest 50% of the money in my wife's name. So by that I can avoid the tax. So whatever money you invest in the name of your spouse will be clubbed in your income. There is a clubbing provision in the Income Tax Act. So you will not get any benefit out of that. You will be clubbed in your income. If you have HUF, if you have Hindu undivided family separate tax file, that can help you a bit. Lot of people give loan to HUF and then invest in the name of HUF. That income is still now not clubbed in the income of individual. If you have any LIC policies which will be maturing, that will be tax free, provided जो उसका sum assured था उसका 20% से आपका प्रीमियम कम था. If you have a 1 crore policy, your premium is 10 lakhs, 10%. Then it is tax free. If it exceeds 10%, it is taxable. Okay. So these are all the things that you need to keep in mind while you are planning your retirement, because taxation otherwise will eat lot of your return. We saw 2% kind of return is eaten out, which is say आपका total return में से 15-20% return तो tax खा जाता है. So if you can plan it a bit, it can be saved easily. So keep this all in mind. Section 80C, a very important section where we get lot of deductions. So section 80C में जो भी deductions आते हैं that can be divided primarily into three parts. One is investment that we do in market linked securities and we get deduction under section 80C. So ELSS, equity linked savings schemes of mutual funds where you have a minimum lock-in period of 3 years, you get whatever is invested in section 80C as a benefit in that 1,50,000. Unit linked insurance plans, whatever you invest in unit linked insurance plans, you get 80C benefit. Fixed income securities like PPF, NSE, infra bonds, tax saving, there are tax saving FDs which have a lock-in period of 5 years in the nationalized banks, even in private banks. Senior citizen savings schemes, employee provident for NABARD bonds, you get 80C benefit. But all these taken together is 1,50,000. It is not taken, 1,50,000 is not individually. Other expenses like life insurance premium, eligible here, repayment of housing loan, principal portion is eligible here. Children's tuition fees. When you pay fees, you believe that everything is tuition fee? No. If you are paid in the school for the food, that is not part of tuition fee. Here it is only tuition fee. Okay.
The commercial loan.
Sorry?
The housing loan. Does the commercial loan is taken into the account?
No, commercial loan will not fall here. If you have any commercial loan, the interest on that part will fall in your profit and loss account. Principal का आपको कोई benefit नहीं मिलेगा उसमें.
Even the mediclaim is above and over this?
Yes, sir. I am coming to mediclaim. I will take the questions once I complete my session. I am coming to mediclaim. So, mediclaim is under section 80D. So, any premium paid for any health insurance plan, which includes critical insurance, which Vivek earlier discussed, critical insurance plan is eligible here. When you get 25,000 rupees as a deduction from your income, this is over and above the section 80C 1,50,000. This is separate from that. If you, this also, total is 25,000. If your premium is say 20,000, you can also get a health checkup. If you have spent something on health checkup, 5,000 rupees, then it can be added, but total would be 25,000. Premium for self and family plus parents. If your parents' premium is also paid by you, 25 plus 25, limit is increased to 50,000. This remains only 5,000, and total is 50,000. Self and family, if your parents, any one of your parents is senior citizen. What is the limit of senior citizen? 60 plus. So if any of your parents is 16 plus, then this 25 plus 25 comes to 25 plus 30. For them you get a 30,000 reduction. So total is 55,000. But here it remains 5,000. Health checkup is 5,000. Total is 55,000. If you yourself, you and your spouse, any of you is senior citizen, any of your parents is also senior citizen, then 30 plus 30, 60,000. Limit is increased to 30. This remains 5,000 and this is 60,000. So this section is over and above section 80C. One very important point, if you have bought any medical policy and you are buying any critical insurance or you are buying a super top-up plan, then please see if your limit is exhausted, then you can buy that policy from your spouse's limit. Suppose I have a medical policy where my premium is 23,000 and I am buying a critical illness or a super top-up where further 10,000 is the premium. So if I take from my account, the limit of 25,000 is exceeded. So I will get only up to 25,000. Whereas my premium is 23 plus 10,000, 33,000. So if I pay this money from my wife's account, 10,000, then it is deducted in her return. So I can claim it fully. Okay? So this is one point which you should keep in mind. With this, I would like to conclude the session. Okay.
Thanks, Prakash, for that. You spoke about retirement plan, but somehow we have noticed that when people actually plan for retirement, or even on the eve of retirement, most people are oblivious of this fact. For instance, you have saved or you have invested all your life, and at 60, when you're going to take that money out, there will be incidents of tax, especially after this long-term capital gains tax on the So, what has been your observation?
So, you want to say that while people are planning for their retirement, on their retirement corpus they are building, they are not considering the tax implication of retirement corpus? Okay. So, most of the people, while they plan their retirement, they don't consider when this money will come, what will be the tax implication. Suppose people speak about, as I said, okay, I have put all my money in the bank fixed deposit. So I would say there was a case which I handled around 6 months back. A person came to me at the age of 60, what you are saying, the same kind of case. He came to me with 75 lakhs rupees and told me that 75 lakhs ka FD karna hai because the interest will be somewhere close to 7 lakh rupees or 6.5 lakhs rupees and my monthly expenses 5 lakhs rupees. Annual expenses 5 lakhs rupees, sorry. So I will be able to meet my expenses. So I asked him, sir, what is your pension? So he told me that I receive a pension of around 5 lakhs rupees. So I told him, sir, on 75 lakhs rupees, you are considering around 7 lakhs rupees of interest. So which bank pays you 9%, 9.5% first of all? No bank pays you 9% or 9.5%. Then have you considered the tax implication because your income from pension is already 5 lakhs rupees? So if you add up further 6-7 lakhs rupees, you will turn up into 30% tax bracket. So average tax that you will pay is 15-20%. So you have to consider the security returns post tax only. If you don't consider them, you will end up like spending more on taxation. Suppose if I give you an example, if I plan my retirement at 8% rate of return, so where will I get 8%? What will be the equity proportion? What will be the debt proportion? What are the estimated returns on equity? What are the estimated returns on debt? And what is the estimated tax implication? That I have to consider. So if I don't consider that, it will eat my retirement corpus earlier than what I plan. So at 75, 80, I will be in a critical situation where the money left out will be less than what I estimated. This situation can come. So this has to be handled from the beginning.
We'll take a few questions. Okay. Yeah. 1 second, sir.
This is regarding long-term capital gain for the shares. You said that in within a year, if the long-term capital gain increases in 1 lakh rupees, then the 10% tax will be there. Now, suppose I have two different shares. One is already making losses, the other is making profit. The total of it will be considered as a 1 lakh or individually?
Total of it.
Total. So, it's important that I continue holding that loss-making share right now, because I sell it, that loss would not be carried forward.
Loss would be carried forward, sir.
Loss also will be carried forward.
Long-term capital loss on equity can be adjusted against long-term capital gain of equity subsequently.
How many years?
To the best of my knowledge, 7 years. Yes.
I just want to ask one thing, that if we have a short-term capital loss, so whether we can file it in a loss section of our taxes, that I have incurred this much losses from my income, So to save taxes that I do not have to pay the taxes on losses, or whether it can be, or like we can also can carry forward
This short-term capital loss from where? Equity or debt?
completely from equity.
So equity का short-term capital loss आपका equity का short-term capital gain के सामने adjust होगा. See, very important point to note it is that whenever you are filing your income tax return, you will see a special income और normal income. ऐसा आप अपने return में कभी पढ़ोगे. So short-term capital loss from equity is charged. Short-term capital gain from equity is charged at a special rate of 15%. Whereas in case of debt, it is at normal rate that you are falling in as per your tax bracket. So if you have a short-term capital loss from equity, it will be only adjusted against short-term capital gain of equity. And short-term capital loss of debt can be adjusted against your other income.
Okay, next question.
When a person is retiring, the PF encashment is considered to be taxable or not taxable? PF encashment. Yes. Yes, it is taxable, sir. There is some exemption limit, basic exemption limit on that, but it is taxable. What is the limit? I don't remember that limit right now, but there is some limit.
Government bonds are tax free. Government bonds.
That depends upon which bond you are buying. There are bonds which are tax free, but all the bonds are not tax free. Government time to time launches different kind of bonds. Most of them are taxable, but it sometimes launches those bonds which come tax free.
Those tax free bonds are not available.
Right now they are not available.
You have to buy from the secondary market.
You can buy only from the secondary market. There were some schemes which came in past. They are available on the debt market, secondary market, where you can buy it from there in your demat account. That can be taxable.
If you're selling your property, is it better to buy property against a property, or is it better to go for some RBI infra bonds and save that money and retain it for future use rather than investing in a property? So what is the best way to kind of engage with your financial planning? So see, sorry, I didn't interrupt you. You sell it in 5 CR and you are in requirement of only a 1 CR kind of a property. The remaining 4, where would you want it to get invested into?
So sir, when you say property, Income Tax Act में properties for capital gain calculation, capital gain tax calculation is defined in different way. Whether it is an agricultural property, whether it is a house property, whether it is a commercial property, there is different tax treatment.
Talking about housing and commercial.
So there you get a tax deduction if you invest in even REC or NHAI bonds up to 50 lakhs for the capital gain. Your question is that whether I should invest in property to get that deduction or I should pay the tax and invest that money. So that depends on that's your personal call. Suppose you got 5 crores rupees and 1 crore property is required, remaining 4 crore is pending. So that 4 crore पे अगर आपका 4 crore का capital gain है उस पे you will have to pay 20% post indexation. ठीक है? So then you get that money. Suppose I believe that there is no indexation, 4 crore पे 20% भरना है. So your money you pay 20% on 4 crores, so it is somewhere close to 80 lakhs. So 320 is your net receipt. Against that, if you invest in property, what is the estimated gain that you can project? Suppose you see that the property can gain you 10% return and money which you get 3 crore 20 lakhs post tax will gain you say 12% return. So we have to find out a break even point. कितने साल में वो उसको क्रॉस करेगा, क्योंकि यहाँ पे you have 320, you will invest 320, so your return of 12% or 14% or 15%, whatever you are estimating, will come only on 320. Whereas in case of property, you are investing 4 crores, so the return will be on 4 crores. So what is the return we are projecting? In financial asset classes, you have equity and bonds. So if you are an aggressive investor, you will put more money on equity side. Say 70-80% of your money on equity mutual funds or direct shares. So the probability of returns there is 15-18% and debt पे आपको 7-8%. So on an average your returns can be 12-14%. Whereas in property, we cannot predict the returns. It depends upon where you are investing, which city. Every city has a different kind of market. But overall, I feel in cities like Ahmedabad and Baroda, it is difficult to generate more than 6-7% return from here onwards. So better to put that money in the financial asset class.
So instead of investing in the property, if I'm looking at investing in after indexation, that 20% tax implication, which is I'm eligible for. I need to go for the capital gain bonds. I mean the bonds, RBI bonds, which I was talking about. That is a substitution against the capital gain tax.
But that is only available only up to 50 lakhs. So if I have a capital gain of 1 crore rupees, I can invest 50 lakhs and get that exemption up to 50 lakhs. Remaining 50 lakhs, I have to pay tax or I have to invest in property.
What if the property is under a couple of heads, 3 or 4 family members? So that would be divided into those heads?
Yes, it will be separate.
Okay. Thank you.
Senior citizen, for senior citizen, there is hello. Sir, senior citizens certificate, it is on accrual basis.
Senior citizen saving schemes you have. Yes, it is on accrual. Any income under interest head gets taxed in income from other sources. It is charged on accrual or receipt, whichever is earlier. So income accrues first, you may receive it later on if it is a cumulative. Here you receive आपका जो senior citizen saving scheme है सर उसमें accrual और receipt दोनों साथ में होता है. Every quarter you receive the interest. So it is chargeable on accrual basis or receipt basis, whatever you consider, but it is chargeable there only.
And the post office
accrual basis.
Thank you.
The second.
Section 86 you get 1.5. Apart from that, I think 50,000 is for NPS as well.
Yes.
So what would be your take on NPS as an investment and for someone who's above 32% tax bracket?
Okay. So one thing which we need to understand about this 50,000 rupees benefit in NPS is people believe that 50,000 when I invest 50,000 I save 30%. It happens only once. Suppose I am 31 years old, suppose, and I invest 50,000 rupees. So I am 30% tax bracket, I am falling 30% tax bracket. So I save 15,000 rupees tax. So net investment, actual investment that happens is 35,000 rupees. Okay. And what you have to understand is that money goes into NPS, which is blocked up to 60 years of age. Pension is taxable. So this question will change from person. The answer of this question will change from person to person. If I am an entrepreneur, I am going to work after 60 also. So I will be in a high tax bracket for my lifetime. So I would not prefer to go for that NPS because income which will come post 60 will also be taxable. Okay, and I lose the control of money up to 60 years of my age. Whereas if I invest in mutual funds on my own and build my retirement corpus, I have full control. There are limited fund managers in that pension scheme. They are also being paid very less by the government. So how the performance will do, that is a question that time will answer actually. Okay.
That's it. What about?
That was the same question actually.
Same question. Oh, okay. Thank you so much.
Thank you so much. Thank you.